Hello and welcome to the Morning Filter. I'm Susan Jabinski with Morningstar. Every Monday morning, I talk with Morningstar Research Services Chief U.S. Market Strategist Dave Sequeira about what investors should have on their radars, some new Morningstar research, and a few stock picks or pans for the week ahead. So, good morning, Dave. Happy Monday. This week, you'll be watching for the CPI and PPI numbers. What are the expectations given the inline PCE reading that we saw in late November?
Hey, good morning, Susan. I just can't believe it's December 9th already, but happy holidays to you and to everyone else out there that's viewing this program. Yeah, so let's get into it. So CPI, it looks like that gets released Wednesday morning before market open. The consensus estimate for headline CPI on a month-over-month basis is 0.2% and 0.3% on a core basis, which puts us pretty much in line with the Cleveland Fed nowcast of 0.27%. Looking at it here on a year-over-year basis, headline consensus estimate of 2.7, and then core on a year-over-year basis, 3.3. So it looks like inflation still relatively sticky here, in the short term. Then on Thursday before market open, we have PPI. Looks like both on a month-over-month basis for headline and core, the consensus is 0.3%. I did talk to Preston Caldwell at the end of last week. He's the head of our U.S. economics team here at Morningstar. And from his viewpoint, assuming inflation comes in at expectations or even slightly better, he'd still hold to his base case, looking for a 25 basis point cut at the Fed meeting here in December. But he thinks that after that, the Fed may then move to like an every other meeting pace where they probably skip in January, cut in March, and so forth over the course of next year.
All right, turning over to earnings, we have a few companies reporting this week that we've talked
Mhm.
about on this show before. The first being Adobe, which has been a pick of yours a couple of
Mhm.
times this year. How's the stock look heading into earnings, and what will you be listening for?
Stock still looks pretty good to us. It's a four-star rated stock, trades at a 13% discount to fair value. Now, it did look like it had a pretty good week last week. It traded up pretty significantly after DocuSign, released their earnings. It's a company with a wide economic moat, although high uncertainty. But of course, in that tech sector, pretty much everything's at least a high uncertainty. But I would note this is probably one of the few companies where we can point to already offering AI services in their product offerings. So I think on the conference call, people are going to be listening for, just any color or commentary that management may give on engagement with that AI offering, or if they have like any other additional AI offerings, in the works, all of that will be very closely scrutinized. And just taking a quick look at our financial model here this morning, for our compound annual growth rate for the next 5 years for the top line, you're only looking for 11%. So I think anything that they talk about that could, cause our analytical team to revise their estimates upward, on the top line would be definitely a positive or a tailwind for the stock in my point of view.
Now, we also have Broadcom reporting this week. Again, big semiconductor name,
Mhm.
AI beneficiary. Stock looks about fairly valued. What's Morningstar think about the company, and what will you want to hear about on this call?
Yeah, I mean, it's really been a huge AI beneficiary. I actually looked at the charts here and, going back to the beginning of 2023, we've increased our fair value estimate by 150%, since then. And even still, that stock is trading at a 16% premium to fair value, puts that into the bottom of the two-star, territory. 1.2% dividend yield. But I'd note the stock actually traded up 11% last week. I took a quick look through. I didn't see any news really that prompted that. So again, starting to get to be a little overvalued, in our point of view, but still strong company, wide economic moat, medium uncertainty. Yeah, as you noted, it's been riding high on its artificial intelligence business. So any commentary that they provide there, won't be important only for its own valuation, but for all the AI leveraged stocks. Looking at the rest of their business lines, VMware, that's also been growing well. So we're looking for continued, solid to strong guidance there. But I did talk to our analyst end of last week on this one, and he noted that I think a lot of people, including himself, are going to be listening for any commentary on their non-AI chip business. That's really a more cyclical part of the market that's been beaten down, pretty hard. So if we get any glimmer of hope for a turnaround, I think that could send, this stock as well as any other, non-AI semi stocks higher if they've really just been, languishing as the global economy has had a relatively moribund, economic outlook. And he noted here, like one good example of, other legacy networking stocks that could do well if we do start seeing that turnaround would be Cisco.
All right. And we also have Costco reporting this week. And in the past, you've noted that Costco is more
Yeah.
overpriced than Nvidia. So is that still true heading into earnings?
Still true. And, my point of view, I just don't get it. Like Costco, great company. I personally enjoy shopping there ourselves, company with a wide economic moat and a medium uncertainty. But, the stock trades at 49 times next year's projected earnings. You compare that to Nvidia, which only trades at 33 times, next year earnings. When I take a look at the valuation of the stock, puts it well into one-star territory, trades at an 84% premium to our fair value. Thinking about this quarter, is there any reason why Costco won't do well this quarter? Not that I know of, but once the market loses faith, in the growth rate of this stock, I think this is one where there could be potentially a lot of downside at some point in time in the future.
All right, let's pivot over to a question from one of our viewers. Before we do, though, I'd like to thank everyone who tuned in for our viewer mailbag episode last week. And I'd encourage viewers to send their questions our way because you never know when we might answer your question on the air. Email us at themorningfilter@morningstar.com. And as a reminder, Dave cannot provide personalized investment advice. All right, on to a question from Eric. Eric notes that you talk about a stock's PE ratio on occasion, but you also say that Morningstar doesn't take PE ratios into account when valuing stocks. So why not? And what are the most important metrics Morningstar uses to value stocks instead?
Yeah, that's exactly correct. We do not use the PE ratio in and of itself as a basis for determining valuations. In our view, when we think about, what a stock should be worth, the intrinsic value of a stock is technically just the present value of all of the free cash flow that would accrue to shareholders over its lifetime. So we use a standardized discounted cash flow model in order to calculate that. So essentially, that model just calculates the present value of that future free cash flow stream, which is then discounted to the weighted average cost of capital. So PE, in my opinion, and the way I try and talk about it, is just a shorthand way to try and estimate intrinsic valuation or really kind of reflect that. Now, a lot of people will use that forward PE. They apply it to, the 1 year forward earnings multiple. And of course, when you think about PE ratios, the higher the PE, the higher the assumed growth rate. But, my view, I think there's a lot of problems with trying to use PE as a valuation tool in and of itself, as opposed to just using it as a tool to try and, convey, what the valuation of a stock, might be. So for example, when I think about a PE ratio, it doesn't account for differential in growth prospects over different periods of time. It kind of just assumes an average growth rate, over the future. So when you think about it, some stocks may have, very rapid growth in the short term that might fade very quickly, or maybe you have, faster growth in the future if earnings growth is slow for whatever reason for the next couple of years. Yeah, I don't think the PE ratio also accounts for the differentials, between, free cash flow versus GAAP earnings. And then lastly, I just think you have to be careful using a PE ratio. Sometimes it can tell you the wrong thing at the wrong time. So for example, a company that's very cyclical may actually have a very low PE ratio and look cheap, but that might also be the same point in time that the economy is running hot and the market knows that its earnings will end up falling, over the next couple of years. Or conversely, that PE might be really high after the stock has already fallen and the market expects earnings then to ramp up as the economy recovers. So again, it's a way I try and use it, to try and convey, relative, fair value, but it's not how we actually calculate the fair value of a stock.
So then, Dave, given all that, why do you talk about PE at all for
Yeah.
some stocks? You did just mention it for Costco.
Yeah, so in a format like this, it's just very hard to try and, quickly communicate to investors, how to do a DCF evaluation. Essentially you kind of need to walk through all of the inputs, all of the assumptions, the entire, kind of projected time frame that we model out. And I don't think I've ever actually tried to argue, a stock should trade at like a 18 times or versus, a 20 times, but use it as a way to try and highlight those situations, especially where we think valuations have just really gotten significantly, out of whack. So it's one of those things I think, PE is best used as a relative value measure more among companies, in a similar sector with similar business lines, similar outlooks, more for a relative value perspective than it is necessarily for an absolute value perspective. At the end of the day, I still recommend going to morningstar.com, read the research that's published by the equity analyst, take a look through the company's SEC filings, read through the management discussion and analysis section, listen to a couple of earnings calls, make sure you fully understand the investment thesis of a stock, before investing in any particular company.
Well, thanks to Eric for that very thoughtful question. And of course, to you, Dave, for your thoughtful response. Okay, so let's turn to some new research from Morningstar, starting with Okta and Zscaler, two cybersecurity companies that reported earnings last week. And regular viewers of the Morning Filter know that you love the cybersecurity sector, Dave.
Oh, that I do. I really like the fundamentals and how the cybersecurity, is set up, from my point of view. Taking a look at the companies that reported last week, we had Okta, nice pop in the stock after earnings there. In fact, that was enough to put that stock into the bottom of the 3-star range, coming up from 4 stars. But, it's still about 15% undervalued. When I look at our cybersecurity names, I think it's still the most undervalued here. Looking at the quarter, sales grew 14% year over year. Margins expanded, 600 basis points to 21%. And then our analyst also noted that management raised its sales and adjusted margin outlook for 2025. So everything's looking, pretty good here. However, the increased guidance was in line with our expectations already. So our $100 fair value estimate is unchanged following the news. The other stock that reported was Zscaler. Now, that is a 3-star stock. We left our $213 fair value unchanged. Now, interestingly, the stock slumped after earnings. I think the market was disappointed by some slower billings growth. I think we've had some turnover on the sales team, but looking forward, we still forecast sales growth will rebound over the next couple of quarters as the new sales team gets up to speed and ramps up. Taking a look at our model, we're still projecting over 20% compound annual growth rate for revenue and earnings over the course of the next 5 years. And looks like the market pretty quickly, kind of came back around to our view. Looks like that stock recovered at the end of the week and is actually now higher than it was pre-earnings.
So then neither stock is a buy today, but maybe keep them on a watch list.
Well, definitely keep them on a watch list, although I wouldn't argue if you wanted to start to scale into a position, Okta here, I would just say, if you do that, keep some dry powder, that way you can dollar cost average in if we were to see any kind of retreat with a broad market sell off over the next couple months or next couple quarters.
All right, Salesforce also put up some great results last week, and the stock
Mhm.
was up after earnings. Looks like Morningstar raised its fair value estimate on the stock a bit too. So, why the fair value boost? And is there an opportunity here today?
Yeah, overall, as you noted, pretty strong results for earnings, but more importantly, our analyst noted here that he expects revenue acceleration in the coming quarters. And I think that's what really lifted our fair value up to $315 a share from 290. Now, it's a 3-star rated stock, but I would note it's at pretty much the top end of that 3-star range. Any moves higher here, you'll take it into that 2-star territory. He also noted there's just a lot of excitement about Agent Force, which, in his view, he thinks that actually represents probably one of the better long-term opportunities out there to transition from what he considers to be a mostly human agent labor force to a mostly virtual agent pool.
Now, we had both Dollar Tree and Dollar General report last week. Now, results were pretty grim for these two retailers the quarter prior. So, was the news any better for the most recent quarter?
That's a yes and a no kind of answer. So at Dollar Tree, there was no change to our fair value estimate. Results were essentially in line. Same store sales were up 1.8%. Not necessarily, not going to cover off the ball, but at least, going in the right direction. But we did see operating margins on an adjusted basis expand, 40 basis points, getting up to 4.5%. So again, things going in the right direction there. However, at Dollar General, we lowered our fair value by 10%. It really is a combination of both incorporating the impact from some store remodeling, increases in cost of labor, at the same time that spending in lower income households remained under pressure. So same store sales were up 1.3%, moving in the right direction, just barely positive. But unfortunately, profitability was lower than our forecast. So overall, the story in the sector is still somewhat the same as what we've been talking about really since the beginning of the year. Still seeing that ongoing shift in purchasing patterns. The rate of inflation may be slowing, but the compound impact of, inflation over the past 2 years with wage growth lagging, really still you can see how much it's taking its toll on lower income households and to some degree even middle income households. So that spending, shifting towards, low margin consumables and less on the high margin discretionary goods. So the long-term investment thesis here, and maybe it takes a little while for it to play out, but once wage inflation, starts to catch up to inflation overall, spending patterns will end up normalizing. We'll see that spending, shift back to discretionary items, which of course then will end up leading to an increase in operating margins over time.
Now, there's clearly a lot of short-term uncertainty here, but does either stock, either Dollar Tree or Dollar General, look attractive for a long-term investor?
Mhm. Well, it's interesting. So I actually looked, over the history of these stocks, and both of these stocks started the year, in well into overvalued territory. Both were rated 2 stars at the beginning year, but they've been hit, especially hard. Dollar General is down over 40%, Dollar Tree down 50%. So at this point, for long-term investors, we do think the market has sold off, too much. Both are undervalued. Both trade at somewhat similar discounts to fair value. However, the Dollar Tree rating is 4 stars, and that's because we rate it with a high uncertainty. That high uncertainty requires a greater margin of safety to get to the 5 star territory, whereas Dollar General is a 5 star rated stock because our uncertainty rating there is a medium. I would just note that, here in the short term, kind of looks to me like the Dollar General fundamentals might be the weaker of the two. But, either way, I do think this is probably a situation that from an investor point of view, it will require some patience, waiting for wage growth, in lower income households to catch up over time to the broad inflationary pressure we've seen over the past 2 years.
Now, we've also talked about Brown Forman on the show before, and the stock soared last week after posting better than expected results. So, was Morningstar as enthusiastic as the market with the results? And are there any changes to the fair value estimate on the stock?
Well, I mean, our fair value is unchanged, remained at $55 a share. I think the takeaway here is that results were, in line with our own estimates. But as you noted, the stock was up as the results came in better than the market expectations. But, even more importantly, I think the management comments that sales trends, kind of look on track to rebound in the second quarter of fiscal 2025, after we've seen an extended period or a slump really over the past year. I think that going forward is really what's going to help, support this stock in the near term. It is a 4 star rated stock that trades at a 19% discount to fair value.
Now, what about tariffs in Brown Forman, Dave? Is that
Mhm.
an issue for the company?
Yeah, we shall see. I mean, it's really very cloudy to figure out at this point in time, what tariffs may or may not be implemented. Specifically here, our analyst noted that 7% of the company's sales are from tequila. So that, of course, could be negatively impacted by a tariff on imports from Mexico. But really, I think the bigger concern would be, if tariffs are put in place on the EU and if we saw retaliatory tariffs, put in place on US imports, that would take its toll here, on the top line. Whiskey sales to Europe make up about 15% of the company's total sales.
Now, Dave, you published your final stock market outlook of 2024 last week, and viewers can access a link to your outlook beneath this video. So, what are you expecting in terms of market behavior for, the rest of the year?
Yeah, of course, it's always going to, be barring some exogenous shock, that hits the markets. I think U.S. markets just want to coast into year end. I think there's probably pretty limited upside here. We're already up, I think, like 29% year to date. But with those kind of returns, I think portfolio managers and traders generally just want to lock it in. They just want to close out the year with those gains. Over the next 2 weeks before the holiday, we will probably see some tax loss selling here and there, some window dressing, but generally, I don't think a lot of people are going to want to take, any large directional bets or just really take any large positions one way or the other.
So, do stocks still look overvalued?
They do. In fact, it just appears with the market continuing to keep, drifting upwards, we are getting, further and further into, overvalued territory above a composite of our valuations. Right now it looks like stocks really priced to perfection, trading at about a 5 to 6% premium, over a composite of our fair values, which, a lot of people may say, 5 to 6% isn't that much. But when I look at our price to fair value metric going all the way back to the 2010 timeframe, less than 10% of the time have we been at this much of a premium or more.
So, do you think investors should be worried about today's market valuation, or do you
Yeah.
think maybe the market rally still has some legs?
Valuations are, of course, a major concern in my mind, but I still think at this point, most investors should probably remain market weight. I just think this is one of those times that valuations can probably remain high for a period of time until earnings growth, kind of catches up. When I look at the macro dynamics of the market, I still think the tailwinds that we have right now overwhelm the headwinds. So looking into 2025 here, looking at the estimates coming from our US economics team, they're still projecting inflation to moderate over the course of 2025. In fact, getting down to below the Fed's 2% target. They're still looking for the Fed to ease over the course of next year, getting the Fed funds rate down to 3 to 3.25% by the end of 2025. Of course, globally, we've still got the European Central Bank easing as well, whole host of monetary and fiscal stimulus coming out of China. Yeah, on the long-term interest rate perspective, they're looking for the 10-year Treasury yield to get down to 3.6% by the end of next year as well. And of course, we still think we're in this soft landing environment, for a slowing rate of economic growth, but no recession. And then lastly, of course, now we've got all the expectations of, what President Trump may or may not do. I think everyone's looking for an extension of the 2017 Tax Cuts and Jobs Act. I think people are pricing in a higher and higher probability of cuts to the corporate business tax and potentially personal tax rates, looser regulatory burdens. So we're also looking for a big ramp up in mergers and acquisitions next year, especially in the tech space.
Now, you also say in your new outlook that you think there's one
Yeah.
wild card that could upset things. Tell viewers what that is and why.
Yeah. I mean, at this point, I think probably the biggest threat to the US markets, in the short term next year would be the potential imposition of tariffs. And so at this point, now we're just kind of in this wait and see mode. How much of this is campaign rhetoric? How much of this are they really going to end up implementing at the end of the day? And of course, President Trump always a bit of a wild card. Is he going to come out swinging on day one and implement, huge tariffs, across the board, try and force other countries, to the table to negotiate and get concessions? Or is this, the art of the deal? Is this really
Mhm.
just more of a negotiation tactic? Maybe he starts off with a couple small limited tariffs, here and there, and uses that as kind of the hammer to try and get people to come to the table, use the threat of additional tariffs in order to get concessions. And of course, it's going to be a matter of how much and how fast is it implemented, what geographic regions are we going to be included, what products are included, and just as important of as far as what's included, what's going to be excluded. Are there different areas or different countries that maybe we exclude, different allies that we don't have tariffs on? Are there specific products that might be excluded? So huge wide range of outcomes on individual stocks. I mean, from anywhere being, the most negatively impacted would be those companies that have a high percentage of, their products are internationally sourced. Looking at the note on Best Buy from Sean Dunlop, he noted here that 60% of, Best Buy's products come from China, another
Mm.
20%, from Mexico. So again, that would be very negative for that company. Companies that can't pass through those costs, and see their operating margin, contract, that'd be negative there. But there also could be beneficiaries, those companies that have a lot of domestic sourcing, especially if they're sourcing domestically, comes at the expense of other competitors whose sourcing maybe comes internationally. Those companies that have strong pricing power, could benefit and see earnings growth there as well. And then lastly, just from an economic, point of view, Preston believes that tariffs would be a drag on GDP forecasts, over the short term. But he noted here too that the ultimate impact on inflation and interest rates would also then depend on, what kind of response we see both from a fiscal as well as a monetary point of view. So again, yeah, huge wild card for next year, one that we will track, very closely. And yeah, as we know more, we will price it into our valuations. But at this point, I think it's too early to tell exactly what's going to happen.
So, as 2024 is winding down, Dave, how should investors be thinking about their equity portfolio positioning in terms of market capitalization and investment style?
Yeah, positioning with kind of the valuation that we have out there is increasingly important. So we still look for an overweight in that small cap category. It trades at an 8% discount. Probably about time to move mid cap to an underweight position as well. That's now creeped up to being a 5% premium, which is also the same as the large cap category. That's also at a 5% premium. We've been recommending to be underweight large caps for a little while now. And in fact, when I look at large cap valuations, the last time we were at this much of a premium or more was back in 2018. And of course, if you remember, that was right before the market corrected, late that year. And historically, small caps tend to do well when the Fed is easing monetary policy and interest rates are coming down, and that's still the environment that we think that we're in. Taking a look at our valuations by category, value stocks are at fair value. That's probably the most attractive part of the market by there. So again, overweight, I'd market weight core stocks. Those are trading at only a 2% premium. And looking for an underweight in growth stocks, or at least a good area to take some profits. Growth stocks trading it at 17% premium. Rarely have they ever traded at this much of a premium. Last time they were up this high was in 2020 and early 2021 during the disruptive technology bubble. So I think as we see, the economy lose steam over the next couple quarters, you probably have a slowdown in growth rates for earnings for growth stocks. So I'd look for a rotation, into value and away from growth.
Alrighty, well, it's time for the picks portion of our program.
Mhm.
This week, you've brought viewers some tax swaps to make, specifically three tax loss candidates and three stocks to replace them. So now, given how well the market's done, Dave, do investors really have that many tax loss candidates? Like, where might they find them?
Yeah, I mean, to be honest, it's actually not a lot of them out there. I mean, with the markets at all-time highs, even what I consider to be, a lot of low quality stocks have all been bid up, over the course of the year. So as you mentioned, very tough to find losses in most portfolios on a year-to-date basis. So at this point, you need to look back, over multiple years in order to find stocks where you might have some embedded losses. So I did a quick screen. I looked for stocks that had losses, year to date over the past 2, 3 years as well. And then also look for those that were rated 1 or 2 stars, those stocks that we think are overvalued. And most of what I found were really only contained within that small cap category. So I expanded that search and I also looked for stocks that are currently rated 3 stars, then picked out a few that just, and again, this is my own personal opinion, but I think probably have a pretty low probability of really taking off here in the short term.
All right, well, let's get to it. Your first stock to sell is DocuSign.
Mhm.
Now, this stock is up 80% this year, Dave. So, how is this one a tax loss selling candidate?
So DocuSign peaked at around, I think, $300 a share in early 2021. Of course, it was bid up during that disruptive technology bubble. Stock just got crushed. It dropped into 4 star territory and remained there for much of 2022 and 2023. As you noted, it's rallying this year. It's bounced well off of its lows, but at this point, we think it's probably rallied too much. So this is one that if you'd happened to buy it, during that disruptive tech bubble, now might be a good time to exit. I think at this point you can realize, those tax losses if you have them. Plus, you then are able to sell this stock as it's well above its intrinsic valuation. Now, I'd note they did report pretty solid earnings at the end of last week. In fact, we bumped up our fair value to $80 a share, but stock closed at 107 last Friday. It's, a company with no economic moat, a high uncertainty. So at this point, it's a 2 star stock trading at a 34% premium.
So, Dave, the stock you suggest buying in its place is Adobe. And you must really like Adobe because it's the second time we're talking about it today.
Oh. Well, and I'm also going to note here, I am taking a bit of a risk recommending this one right now. They do have their earnings coming out after market close on Wednesday this week. So if for whatever reason, they were to miss earnings and that stock sells off, I might look stupid here. But having said that, Adobe is one of the very few large cap tech stocks that we think is undervalued. It's rated 4 stars, trades at a 13% discount to fair value. And so while large cap tech stocks, overall as a category are overvalued, I still think that investors, do need to have some exposure in a diversified portfolio in that category. So in this case, I think Adobe meets, the bill. It's a company with a wide economic moat, which is supported by switching costs. Our analytical team has noted that in the software space, the more critical function it is, the more touch points you have in an organization, the higher the switching costs for a software vendor, and that's what we see here. I'd also note too that the company has what we consider to be an exemplary capital allocation. Now, I don't talk about capital allocation, very much, but in this case, I'd note only 20% of our equity research coverage has an exemplary capital allocation rating, so just kind of another factor in its favor here. But long term, when we think about our investment thesis, Adobe is the dominant player in content creation across print, digital, and video. Our analytical team had noticed that they did introduce Firefly in 2023. They think that's an important AI solution that will attract, new users over the next couple of years. Looking at our financial model, top line growth, compound annual growth rate over the next 5 years of 11%. Add in a little operating margin expansion that we forecast, you come up with 13.2% compound annual growth rate for earnings for the next 5 years. Now, the stock does trade at 27 times earnings, so it's certainly not cheap, but relative to a lot of other, situations we see in tech, it seems pretty reasonable to us.
Now, your next sell candidate is Intel, and Intel
Mhm.
stock has been really a train wreck this year, and the company's CEO retired just last week. So fill in viewers.
Yeah, so Intel is a three-star rated stock, but it trades really almost right on top of our $21, fair value. I'd also note that, not only has the stock been under a lot of pressure, but the company did halt its dividends, so no dividend payment on this one, at least for the foreseeable future. We rate the company with no economic moat. And actually, I have to note here, we actually stripped Intel of its narrow economic moat back in August of 2023. And in fact, this was a company we had a wide economic moat rating on back in August of 2022. So since we started taking that moat rating away, that stock is down about, I think, slightly over 40% since August of 2022. And we also have a very high uncertainty rating here. Essentially, the short story is, unfortunately for Intel, they fell behind in the semiconductor upgrade cycle, and now they just have to spend a boatload of capital expenditures just to try and catch back up. Now, we still think they will be the leader in traditional semis used in PCs and servers for at least, several more years, but I think our analytical team is very concerned that Intel's best days may be behind it. In fact, this might be one of those ones that's transitioning from what we consider to be, traditional technology into now legacy technology. They just have to catch up on a manufacturing basis with Taiwan Semi, and that's just to be able to pull even, much less try and become a leader again. So while this one is at fair value as far as where the stock is trading, in my opinion, I just don't think you're going to miss much on this one, in the short term. This stock is at its lowest price since 2013. So I think in this case, there are a lot of losses, to harvest. And I think at this point, you can reinvest that money in a better story.
All right. And you think that better story is Microsoft. Why is that, Dave?
Yeah, so Microsoft, really not much of a discount, only a 9% discount to fair value, but enough to still kind of keep it into that 4-star range. Maybe it's kind of creeping into the bottom of 3-star, but it's a company that still has that wide economic moat, only a medium uncertainty rating. And really, I mean, the company's still just hitting on all cylinders. Last quarter, our team noted that their productivity and business process business was up 13%. Their PC business expanded 17%. Their intelligent cloud business up 21%. And of course, that's where the real attraction lies for Microsoft. They've done, just a really great job capitalizing on the rapid increase in demand for AI computing power. We're still seeing demand increase for, the hybrid cloud environments in general, and specifically in this case for their cloud platform, the Azure business. Now, we think that the Azure business has been capacity constrained over the past couple quarters. So we expect that with as much CapEx as they've been spending there, we're looking for capacity expansion to accelerate growth over the next couple quarters. So even with that additional CapEx spending, they've been able to hold their margins. So again, just a much better story, in this case.
So then your final stock to sell this week is Franklin Resources. Now, here's a company and a stock that are having a terrible, horrible, no
Yeah.
good, very bad year. The asset manager has been experiencing outflows, stemming in large part from controversy at its bond shop, which is
Mhm.
Western Asset Management.
Nice, Susan. I like the children's book reference there. For those of you that don't know that, that's Alexander and the Terrible, Horrible, No Good, Very Bad Day. Excellent book if you have young children to read to. But getting back to the story, in this case, it's not just that; it's the terrible, no good, very bad decade. This stock is down, 60% over the past 10 years. And you highlight it is experiencing outflows stemming from controversy at its bond shop, Western Asset Management. Looks like what was going on here is a portfolio manager was steering winning trades to their high fee funds and then steering the losing trades to their low fee funds. But it looks like to me, I think issues appear to be running out even deeper and longer than that. We currently rate the company with no economic moat. We stripped them of the narrow economic moat in September of 2024. And in fact, we had lowered them to narrow from wide back in September 2018. Stock is down 26%, since September 18. Currently, it is rated 3 stars, trades almost on top of our fair value. Granted, it does have a very high dividend yield of about 5.8%, but from a principal perspective, in my opinion, I just don't think you're going to miss out much on this one in the short term.
So the stock to buy in its place, sort of this asset manager swap, would be BlackRock. Now,
Yeah.
BlackRock looks fairly valued according to Morningstar, but why do you like it as a replacement idea anyway?
Yeah, essentially, this is just a swap idea. You pull out a couple percent of fair valuation pickup, but as you noted, BlackRock is a 3 star stock, only trades a few percent below our fair value, and it only pays a 2% dividend yield, so not necessarily that attractive on a swap basis that way, but it is a wide economic moat. You're picking up switching costs, you're picking up intangible assets. And our analytical team noted that, the barriers to entry in the asset management business really aren't all that significant, but the barriers to success are extremely high. It takes a very long time period, a lot of skill to not only put together a long enough track record of investment performance, to really start gathering assets, but to then have enough assets under management to build the scale necessary to be able to compete. Here you have, all of that. So I think you can, capture the tax losses, in Ben, pick up BlackRock, swap out of a slightly overvalued stock for a slightly undervalued stock, and you pick up the wide economic moat in that swap.
All right. Well, thanks for your time this morning, Dave.
Mhm.
Viewers who'd like more information about any of the stocks Dave talked about today can visit Morningstar.com for more details. We hope you'll join us for the Morning Filter next Monday at 9 a.m. Eastern, 8 a.m. Central. In the meantime, please like this video and subscribe to Morningstar's channel. Have a great week.